Hi, and welcome back to our video series covering the Registered Disability Savings Plan. Once again, you'll find this video useful if you're going through a course like the Life License Qualification Program or through a financial planning designation course of some sort. So in the first video in the series, we looked at money going into the plan. We looked at contributions, and we saw that those contributions are being made with our pre-tax dollars. Sorry, our after-tax dollars. Let me correct that right now. Our after-tax dollars. That is, they've already been taxed. And as a result, we know that when those dollars come out, there will be no tax to pay. That's easy enough. However, we also looked at grants and bonds. And those grants and bonds have never been taxed. And the other thing that would have never been taxed would be any kind of growth or investment returns or interest, or however we characterize the money that's accumulating in the plan, hopefully. Because like any other investment, subject to risk here, and we could actually have losses with such a plan. So we have grants, bonds, and growth. This stuff has never been taxed. So that's an important starting point for our discussion here about the RDSP. Now, we did mention in the previous video that the RDSP is really best thought of as a long-term savings vehicle. It's not designed to provide immediate income for a disabled person. What it's really designed for is to provide income for a disabled person who is a little farther along in life, and now maybe they don't have their parents around anymore, or their siblings, or whatever it happens to be. Their traditional support is gone, and they need to rely on their own financial means to get by. So, the intent of the plan originally, and this is where the kind of target for the plan was to provide what are called Lifetime Disability Assistance Payments, the LDAP. So we have the Lifetime Disability Assistance Payment here. The LDAP. And this is, for those of you that are familiar with the RRSP, very similar to a RIF type withdrawal schedule. This schedule starts at age 60. So you would enter into your LDAP schedule at age 60 or earlier with shortened life expectancy. So if you have a doctor who says, yes, this person is not likely to live to a normal lifespan, then you can apply here to start accessing funds early. And it wouldn't be uncommon, of course, for somebody who suffers from a disability to qualify here under this shortened life expectancy. So the LDAP, it starts at age 60 or earlier if you apply for it and qualify under the shortened life expectancy provisions. And basically what this does, this requires you to make annual withdrawals now, very similar to the Registered Retirement Income Fund. So now we have to start taking funds out. And because we have to start taking funds out, obviously there are going to be some tax consequences. So it's all proportional. It's not like the RESP where you can essentially pick and choose what each dollar is. Here, a withdrawal has a proportional calculation in it where we determine a certain proportion to be contributions and a certain proportion to be grants and bonds and growth. So what happens here, out of each withdrawal, the portion that's deemed to be contributions, that comes out tax-free. Well, the portion that's deemed to be grants, bonds, and growth, and the formula for this is actually quite complicated, but HRSDC, Human Resources and Skills Development Canada, will take care of it for us. Our grants, bonds, and growth that stuff is all going to be taxable. Now, generally, that's not too big a deal because, of course, when you're taking this out as a disabled person, you probably don't have great income. Hey, good for you if you do. That's great. And then you just pay tax. And as I always say, anytime we have a discussion around tax, there are worse problems to have than paying a lot of tax because generally it means you have a lot of income. But for the most part, a disabled person is going to qualify for disability tax credit. Obviously, you have to use this plan, basic personal amount, and probably have low income, which renders this probably less consequential than it would be for somebody who has a ton of other income. But it still is taxable, and it is something to consider. Now, that's one source of payments that we can take. The other source we can take is really a one-off, just called a disability assistance payment, a DAP or DAP. And what you're doing here is you're just taking one payment out. Now, to do this, you have to be, unless again there's a demonstration of shortened life expectancy, but we're looking at minimum age 27. And what happens here, this compels a payment, a repayment of grants and bonds received in the previous 10 years. So this is not something you want to do unless you have had a plan in place for quite a while and maybe you're not so concerned or you haven't even received any grants and bonds in the previous 10 years. There is an exception to that. The exception is where the plan was primarily funded by an RRSP rollover from a parent or grandparent. So if the primary source of funds was an RRSP from another person, then we don't have this provision. And we're going to talk about that RRSP rollover and how that can impact quite beneficially the RDSP in our next video. Now, when you take a disability assistance payment, we still have much the same consideration here. That is, the tax is going to be pro rata here. A chunk of it is going to be deemed to be return of contributions and therefore tax-free, but a chunk of it also is going to be deemed to be grants, bonds, and growth and therefore taxable. The disability assistance payment is different because it's just a one-off payment. You're only getting that amount for 1 year. You do have to apply for it, and typically there would be some reason for it, like, for example, making a home more accessible or something of that nature. So these are the two primary ways that we can have withdrawals from the RDSP. The third way, a little bit less fortunate, but something we do have to mention, is the death of the plan beneficiary. And this is where we get into a little bit of a limitation. The death of the plan beneficiary automatically results in all untaxed amounts being taxable to the estate of the beneficiary. We don't have a choice here. There's no option. This is where this has to go. So you can't have a provision here where you leave a separate person as beneficiary of your RDSP funds. We have to do it this way. And in fact, the RDSP rules, not even regarding the taxes here, but just in general, require that everything flow through the estate. So the taxed and untaxed amounts all have to flow through the estate. And that's our withdrawals from the RDSP. So basically it comes down to one of three things. The LDAP, which is the real plan for the RDSP, that's what we're intending to do. The DAP, which is this one-off, one-time payment. And death of a plan beneficiary, which requires that the plan all be subject to its tax treatment that it should be subject to. Incidentally, if you have a beneficiary who gets better, and who knows with advances in medical science what conditions might be cured or treated successfully, the recovery of a plan beneficiary has the same result as the death of a plan beneficiary. That is, it renders basically all the untaxed amounts have to flow to that person now and be taxed at that time. Yes, it does create a little bit of a tax burden, but I'm sure that it's more than offset by the positive effects of recovery over here. And one other thing that I'd like to mention, and we're going to talk about this more in the final video in this series, the third video in the series, is that when you have an LDAP or a DAP, there is no interference with government benefits. So government benefits, your government disability supports programs like ODSP in Ontario or SED in Saskatchewan or AISH in AISH in Alberta, your government benefits are unaffected here by withdrawals, which is a fantastic advantage. Many other sources of income would cause your government benefits to be reduced in some sense. So I hope that helps to understand withdrawals from the RDSP. A little bit of detail there, but nothing too complicated, and a lot of overlap between the various provisions. Thanks very much for your attention. I hope this helps, and I look forward to seeing you back for the third video in this series.